Welcome back after the break in our Expert Speaks segment. Now I'm joined by Sumit Ramani, actuary and co-founder of Protect Me Well. We'll discuss a key questions for every individual. What types of protection-focused insurance products should one consider buying and why? Sumit, welcome to Insurance Mantra. It's pleasure to have you with us today.
Thank you, Anurag. Thank you for hosting me.
Okay. So, Sumit, I'll begin with my intro only where I mentioned that biggest confusion with most of the individuals is what kind of protection cover they should buy. And to begin with, at least three protection one should have.
Yeah. Anurag, I think the way to think about it is from the first principles. Think about what all assets do you have, right? And consider yourself and your family also as an asset. And then, of course, the material assets that you have, which could include home and cars. So starting from yourself, think about then the risks that you run, basically the risk of dying early, risk of falling sick, risk of living too long, and risk of getting disabled. And corresponding to them then becomes term insurance, medical insurance, disability insurance. And if you're living too long, I think annuity, immediate annuity is the best product. Same applies for your family. They are also your assets. If they fall sick, of course, there is a financial implication to it, and that should be taken care of. It is best through insurance. Likewise, if you have a car, most people go for only third-party insurance, which is mandatory. But ultimately, if a car meets an accident, you have to pay from your pocket. So also consider having own damage insurance part of it. The last piece, which is generally ignored, is home insurance. People spend their entire life saving to build a home, but do not consider insuring it. But I think that becomes very important part of your overall insurance portfolio.
Okay, Sumit, you spoke about health insurance, term insurance, property insurance, but the biggest question is how much? So that is the worry, or that is a dilemma for most of us to decide, कि, okay, I have to go for a property insurance of my home, which is of worth 3 crore, 4 crore, then how do I get it insured? Then for my life only, so how much term insurance I require? And for annuity, I will ask in later questions.
Thank you, Anurag. And that's a very, the purpose of insurance is to make good the losses, right? And keeping that in mind, let's also start with, let's say, retirement corpus, and then we'll cover everything else. So pretty much everyone has an idea of what their retirement corpus should look like. If it is not, think of it as maybe 30 or 35 times your annual expense. Let's assume that's, let's say, 5 crore, right? Now, let's shift our focus to maybe term insurance and think about what really term insurance is, right? In a crudest sense, it is retirement corpus of your survivors. So if you need a retirement corpus of 5 crores, you probably need term insurance of maybe 3.5 crores, because only the remaining 1.5 crores or 2 crores was meant towards your expenses, right? So that's moving from retirement corpus to term insurance. Now let's switch to disability insurance. So in case of an event which leads to trigger of term insurance, that is death, in reality, your income stops, your expenses also stop. But in case of an event that triggers a disability insurance, which is typically by an accident, your income most likely stops, but your expenses continue and maybe increase. So if your term insurance is, let's say, 3 crore, your disability insurance should be higher than 3 crore. Moving to now medical insurance. The way to think about medical insurance is I would just go ahead and buy the highest cover that is available in the market. as long as I can afford it. And most people think that, okay, if the premium for 20 lakh cover is, let's say, 15,000 or 20,000, the premium for 1 crore would be 5 times of it. In reality, it's just 10%, 20%, 30% extra. And the reason why I recommend to buy the highest cover that is available in the market is because you don't buy medical insurance for today. You buy medical insurance for 10, 50, 20 years later when you would actually fall sick, and that's when the money would be utilized. Given that once you're sick, nobody's willing to insure you, and the fact that medical inflation is in double digits, maybe 13, 15%, the higher the cover, the more likely you are.
Okay, interesting that for medical insurance, one should go for the highest cover available, which you can afford. Very interesting means point you have said, Sumit. But again, I'll go back to your connection between term insurance and annuity plan. So you mean to say that there is a linkage between term insurance and annuity corpus also, and you should have the term insurance of the amount of your complete annuity corpus you want to build.
Minus the expenses that were meant towards you, right? Because in a retirement scenario, we are assuming that you are going to be around. In a term insurance scenario, we are assuming that you're not going to be around. So the expenses which would have been incurred when you were alive, that can be reduced for arriving at the size of term insurance.
Okay, so one should go for higher coverage only, because the basic formula we been saying to everyone that whatever is your annual income, go for 10 times of that coverage, but one should go for more than that.
Absolutely. And I think the thumb rule of annual income into 10 is honestly laughable in 2026. This was good when we did not have systems and things in place. And I think at this point in time, we should just ignore it. And the best way to test any formula is look at extremes, right? If someone like Mukesh Ambani, right, what do you think the size of his term insurance should be? Not 10 times of income. He doesn't need one, right? Because what do you think the size of his term insurance should be? Not 10 times of income. He doesn't need one, right? Because he's already taken care of through his assets. So I think we should just stop using annual income into 10 as a formula.
So what would be your formula? If you have to suggest some formula to our viewer, what formula you will suggest if somebody is watching you now and they want to go for a term insurance?
Yeah, so if I do we, by the way, as you know, run a business which does this sophisticatedly over an API. But to break it down for the end customer, the right way to look at the size of term insurance is your outstanding liabilities, which could be loans, plus all the expenses that your family would incur in the future, accounting for life stage changes. That is, if your kid is in school, he or she would go to college at some point in time, and that has to be taken care of. Inflation, minus whatever assets that you could utilize to take care of your expenses. Those are essentially fungible assets. Think of it as money in the bank account. Minus, or you could also subtract if you have secondary source of income, let's say any passive income through rents and dividends, that could also be utilized to adjust for the size of term insurance. So to summarize, present value of all future expenses, plus any outstanding liability, minus any income from the secondary sources, which is not dependent on you being alive, and minus any fungible assets that you might have. So that's really the heart of it. But yeah.
Okay, it's a little complicated formula, but hope our viewers will get this. My final question to you, Sumit, how important is the critical illness cover, and how can we embed, or we can get the critical illness cover with our life insurance policy or our health insurance policy?
Yeah, so critical illness is very important, especially if your medical insurance cover is not big enough, right? If your medical insurance cover is only, let's say, 20 lakhs and you don't consider it increasing it. Then you should also consider buying a critical illness cover of, again, very high amount, right? Because if you're 30, you're not going to get critically ill next year. You're probably going to get critically ill in your mid 40s and 50s, right? And the way to look at it is, again, I would buy the highest cover that you could afford to buy, and that is available in the market. You can, of course, buy it as a rider along with term insurance, which is what I have done. But it's also available individually that is being sold by general insurance and health insurance companies. But I would, again, go for the highest that I can afford.
Go for the highest insurance cover which is available and affordable to you. Final question to you, Sumit. What would be your insurance mantra for our viewers?
I would say get covered early, especially in case of life and health. Also, ensure that you're fully covered, because the cost of not being fully covered could be very, very high, and it could drastically impact your life and financial planning as well.
Okay, so thank you so much, Sumit, for joining our insurance mantra and sharing your insights. And with this, it's a wrap on this edition of Insurance Mantra, but we'll leave you with our insurance basic. Did you know? A critical illness policy is different from regular health insurance policy. Critical illness insurance covers serious life-threatening diseases like cancer, heart attack, stroke, kidney failure, or paralysis. On the first diagnosis of a listed illness, which I mentioned above, the policy pays a lump sum amount. Hospitalization is not mandatory. The lump sum amount can be used for treatment, medicines, recovery, travel, or even loss of income. In comparison to regular health insurance, mainly cover hospitalization expenses through reimbursement or cashless treatment. So remember, health insurance pays hospital bill. Critical illness insurance gives financial support on diagnosis. Used together, both of them used together, they provide stronger protection during serious medical emergencies. So stay informed, stay protected. That's our insurance mantra.